First up, Reserve Bank Governor Gill Marcus and her colleagues on the MPC committee today announced that they would leave our repo rate unchanged at 5%. Marcus noted that while the domestic growth outlook had deteriorated, the upside risks to inflation had increased and might deteriorate further on the back of further rand weakness. Joining us from Cape Town to discuss the implications for investors, JP du Plessis. He's from Prescient Investment Management. Hi, JP. What was your response, your intellectual and perhaps even your emotional response to that MPC statement?
Well, firstly, let me just say at Prescient, we take emotion out of investing. We look at things on a very analytical basis. But I think we weren't surprised by what the rate, certainly by the rate decision and by what was said by the governor. We have seen inflation surprise on the upside over the last few months, and at the backdrop to that as well is that we've seen their growth forecasts be revised downwards. So the risks look a lot more balanced now than they did a few months ago.
So in other words, not a clear direction of what the next step, if the next move in interest rates is going to be up or down. What's your house view on that?
Well, we don't tend to forecast, but what we do is look at what's being priced into the market. And whereas we were seeing a rate cut priced into the market only a few weeks ago, that's more or less been priced out of the market now. As we've seen, as I said, the inflation numbers come through a lot higher. So that's been moved out of the market. I don't think anybody really expects a rate cut until the middle or even towards the end of next year. It's certainly hard to see a rate hike from here given the economic backdrop. But if inflation continues to surprise on the upside, it wouldn't surprise us if that starts to get priced into the market.
JP, we seem to be obsessed with trying to call the next move in interest rates, and some of the analysis we've been seeing from UBS is that these debt problems that we see in the developed markets are going to be around for a long time, and that means in many cases that we might have interest rates that could be at these levels for a long time. So they may not go down and they may not go up. Is there any sort of sentiment in the market that's saying that maybe we're going to be at these levels for not just 1 or 2 years, but an extended period of time, and this is the sort of new normal that we should get used to?
Well, certainly, if you look at what the bond market is pricing in the front end, and certainly in the FRA market, which looks at interest rate expectations, you can see a very, very flat curve, which talks to your point that the market isn't expecting interest rate moves for quite a long period of time. That is probably the most consensus view in the world right now, that interest rates aren't going to do anything for a long period of time. And it does make life for a fixed income investor like ourselves a lot more difficult. So we have to look at other ways to generate yield, other assets, and it makes our lives a little bit more complicated.
So just in terms of that, I mean, we've heard there's been a lot of the multi-asset managers that manage portfolios across asset classes, especially in South Africa, have been very negative on the fixed income side, and obviously some of the related sectors like the listed property sector, saying that at these levels historically they're very expensive. Is it time to maybe reconsider that and re-look at the attraction of fixed income and listed property in this environment?
Well, when you look at fixed income, it's not sort of one thing. There's a whole yield curve out there, and we look at where we would like to be in terms of that duration view, and depending on which funds we're looking at, whether they're income funds or longer term bond funds, we will look at the valuations and what they're telling us about where we need to be on the duration spectrum, if you like. We've been pretty negative on yields on the longer end for a while, because we think that globally bond markets are not fairly priced. So we think the longer end is susceptible to a sell-off. Listed property bears a lot of resemblances to the bond market. It's clearly a long-term yield. It has a duration to some extent. but it's also a listed equity, so it has the properties of both bond-like returns as well as equity. It's quite illiquid as well. So we haven't been particularly constructive on the listed property sector. So you're quite right. You need to really identify where you want to be on the duration curve, on the yield curve, to maximize returns.
Have you been seeing on that note in balanced funds and multi-asset class funds a shift back towards fixed income in terms of the amount of the portfolio allocated to different classes of fixed income instruments?
Well, it's an interesting one. I mean, within our balanced fund, for example, we're very, very heavily invested in equity. But what we have the ability to do, because we're a quantitative house and we look very carefully and spend a lot of time looking at protected equity, we see a terrific amount of value in buying protected equity, and that allows us to get equity upside, but also to put hedges in terms of equity puts to protect the portfolio if we see a negative equity environment. Let's remember that central banks around the world are basically trying to push investors into taking more risk and pushing investors into equity markets. But as we all know, equity markets come with a lot of volatility, and by having those protected strategies in the portfolio, you can take the upside of equity markets, but also protect yourself from the downside. In terms of bonds, I think that we haven't been invested heavily in bonds in our balanced fund for quite some time, and that's really around the stretched valuations that we're seeing globally.
And JP, within the bond fund, we know it's not just a homogenous blob, but there are nuances there. Outside of just the pure state bonds, if you look at the parastatals, semi-parastatals, and the corporate bonds, do you see different opportunities there, different risk profiles?
Yes, well, we've seen, in terms of credit, we've seen credit spreads come in quite considerably. And but when I say come in, I mean narrow. And so the additional yield that you're getting for taking credit risk has narrowed, and you're not getting paid to necessarily take some of the credit risk. But we are seeing pockets of opportunity. At Prescient, we're very focused on higher quality credits. So we have a large amount of exposure to SOEs as well as to Big Four banks. And we have seen opportunities in the Big Four bank credit bonds, where they've been really preparing for the implementation of Basel III, and they've been looking to issue subordinated debt that will be grandfathered into the Basel III once Basel III comes into effect. And they're paying additional quite attractive yields to do that. They're also trying to lengthen their debt profile because of the way that Basel works, is that it makes more sense to have a longer profile on your debt.
So JP, the dynamics that you've just described imply presumably that we will see greater growth in the South African corporate bond market, and from that greater interest and more opportunities for South African investors.
That's true. We've seen a number of new issuers coming to the market. I think they're attracted by the types of yields that are on offer. It's pretty cheap, both on an absolute basis because obviously interest rates are very low, but also on a relative basis because credit spreads are quite narrow. We haven't had traditionally a great deal of depth in the credit markets, but we're starting to see new issuers, and that's exciting.
JP, just in terms of the numbers, do you have a number that you've got in terms of how much our Big Four, our banks here, need to raise in order to comply with Basel in the next, I think the requirements go as far out as 2019?
I think our banks are pretty well positioned in terms of Basel. In fact, they have capital adequacy rates which are greater than, certainly much greater than the capital adequacy requirements of Basel III. The issue for a number of the banks is as I mentioned before, their debt profile. So they tended to fund themselves relatively short, and it's a requirement that you match your assets with your liabilities, or you try to match your asset with your liabilities, and have a greater match there. And that's really what they're trying to do with the issuing of longer dated longer dated bonds.
So when we say longer dated, we're looking at buying possibly bank debt that matures in about 10 years, or is it even longer than that?
It's tended to be, look, most credit investors in the credit space tend not to push out unless it's sort of very long-term kind of project finance, tend to be in that sort of 5 to 10 year space. The SOEs tend to be able to issue longer, but that's because people use them in all be portfolios and pick up that additional yield in the longer term, as opposed to having government paper in there. But in terms of the credit space, it tends to be in that 5 to 10 year sector. What we've seen recently is bonds being issued 5, 7, 8 years.
JP, I want to bring you back into the equity space, if I may. We've spoken at length about fixed income. Now, one of the inflationary risk drivers that we saw, certainly from the NBC statement today, and as we know, is the currency weakness. What is your outlook on that and the implications, sort of the follow-through on what that means for your equity view, and what sort of stocks would be ideal in your portfolio?
Well, I think we see a lot of risks for the rand going forward. We're running a current account deficit, which is largely driven by flows out in terms of bond flows. We're importing more than we're exporting, so there's a lot of pressure on our currency, and we can see that continuing going forward, and that we do see the potential for weakness there. We don't tend to do look at equity calls purely on the basis of currency moves, but rather what are the fundamental values within equities, what are the fundamental drivers, and then also look for momentum in the equities that we're purchasing. So we like to have a valuation. We are a valuations-based house, fundamental valuations-based house, but we'll look to see what momentum is telling us about those stocks. So where we see a stock that has benefited as a result of currency weakness, that is likely to take a larger part in our equity funds, because it'll have that positive momentum.
JP, obviously the rand depreciation from 8.20 to 9 rand, we've seen it go over 9 rand yesterday, has kind of changed the game somewhat, and if you believe it's sustained, then many industries can actually benefit from this. We've seen the pressure some of the chicken and poultry producers that have come under over the last 3 years because of the supply of cheap imports. Do you think with some of our manufacturing businesses and businesses that rely quite heavily or are affected quite heavily by importing, that there's a potential revival for some of our manufacturing sectors within the country?
Well, no doubt. I mean, when your competition has become more expensive, then that's gonna help you as a business. What we've seen is with the weakness in the rand, that's fed through into the inflation numbers, and that the worry for us is that if we continue to see further rand weakness, that the inflation numbers would continue to pick up. And as investors, that's a very serious problem for us, because as an investor, your primary goal really is to beat inflation and to produce inflation-beating returns. And if inflation is sort of running out of control as a result of a weaker currency, you've got to make sure that your benchmark, if you like, or your hurdle to beating inflation obviously goes up. That's very much the case, is why we have offshore exposure in a lot of our income funds, because as we see weakness in the currency, that feeds through, as we've seen over the last few months, into the inflation numbers. So having that offshore exposure allows you to have a hedge against that currency weakness.